Hello everyone, my name is Siddharth Khemka and I head the retail research at Motilal Oswal. Equity markets continue to remain volatile throughout the month of January, and now we have reached the last week of January, which promises to remain again volatile. Last week market attempted to cross the 11,000 mark, however failed and lost around 1.2% for the week. The pain continued to remain in the mid and small cap indices, which lost almost 3% each for the week. Bank Nifty ended in loss of around 1.2%, mainly driven by a 4% decline in the PSU banking index. The index saw some of the heavyweights getting impacted last week with news of Z promoters getting involved in some of the companies during the time of demonetization, led to sharp fall in the share price of Z Entertainment, which lost almost 30% at one point in time and closed at 26% fall on Friday. In terms of other sectors, the major gainers were energy, led by Reliance, Pharma and IT. In terms of the sharp underperformance as witnessed dragged by Z, the media sector lost almost 17%. The second highest fall in terms of sector was witnessed in auto, which was down almost 7% and mainly dragged by Maruti, which lost more than 10% on back of a weak, or you can say disappointing, December quarter numbers. Some of the other stocks in the heavyweights which were in news last week was ICICI, after CBI filed case against its ex-senior management in terms of the case related to Videocon loan. Yes Bank was in news after it reported its quarter numbers and managed to get RBI's approval for its new CEO and MD. The market volumes continue to remain weak, while the volatility too saw some increase. In terms of institutional activity, both FIIs and DIIs were net buyers, FIIs to the tune of 1000 crores while DIIs to the tune of 1200 crores. On the global front, IMF hinted at slower growth in the global economy, while the peace talk of trade war between the US and China faded, and thus we saw the global markets also remaining mixed. In terms of, in view of the upcoming budget and the general elections, which are just 4 months away, it is important to have a look at the current economic overview for India. The real GDP growth came in at 7.1% in Q2, sharply down from 8.2% recorded in the first quarter. We believe that GDP growth could moderate going forward with around 6.5% in the third quarter of FY19 and further moderating to around 6.3% in fourth quarter, mainly on back of a high base. Further, inflation also surprised on the lower side, falling to 2.2% in the month of December. Do keep in mind that this is the last reading of inflation before the RBI policy is scheduled next week. Given this combination of weak growth and low inflation, we believe that supports a rate cut of 25 basis points in the next RBI policy meet, which is scheduled once the government presents its interim budget. Coming to the union budget, which will be an interim one presented on the 1st of Feb, there are high hopes that after BJP, the central ruling party, losing the major states elections, the hope of that the government will be announcing a pro-rural scheme are very high. However, we believe that such hopes may not yield much desired results for the government. The fiscal deficit is already high compared to the budget estimates. For the first 9 months, it is already at 115%, making it the highest level in the past 2 decades. The GST collections for the year has also been much lower than the expected monthly average. In this background, if the government announces a populist scheme with significant amount of one-offs like a loan waiver scheme wherein the government writes off a significant amount as a one-time exercise, or comes out with a recurring expenditure like a universal basic income kind of a scheme, the rate cut for the RBI will become difficult, as the fiscal spending could fuel inflationary fears. Given the fiscal constraints, as well as our expectation is that the union budget may not include any major surprises of higher deficit or any out of the box thinking populist schemes in the current environment. However, we need to watch this space very closely, given that it would be very important factor for the economy as well as for the equity markets. Coming back to markets, the key events lined up this week is the US Fed meeting for reviewing any change in the interest rates scheduled on Wednesday, India's April to December fiscal deficit data on Thursday, the FNO expiry again on Thursday, and the big event, which is the interim budget to be presented on Friday. The Q3 earnings continues with many heavyweights like HDFC Limited, ICICI Bank, Axis Bank, Bajaj Finance, Hero Moto, Titan declaring their results during the week. Nifty started last week with a positive note and made a high of 10,987, almost trying to touch 11,000, but unsuccessful, and later on traded in a narrow range till Thursday. On Friday we saw sharp correction in the Nifty, mainly back of the selling pressure witnessed across the markets. Technically, Nifty has made a bearish candle both on the daily as well as on the weekly charts. As seen earlier, Nifty has made many failed attempts to cross the 11,000 mark in the past 6 weeks, and only a decisive crossover could lead to a rally further. For this action-packed week with the January FNO expiry, corporate earnings and budget, these events will keep weight on the market and could keep things volatile for the market. That's all. Thank you.